Have you ever looked at your tax bill and thought, I worked too hard to be paying this much? Or maybe you're making great money, but somehow feels like the IRS is your silent business partner. They're taking a bigger cut than you like, and each year they keep getting a bigger piece. I get it, and you're not alone. In fact, I talk to business owners every single day who say the same thing. I'm tired of overpaying in taxes, but I don't know what to do about it. That frustration comes from not knowing the rules of the game, really. Because here's the thing, the wealthy don't have a different tax code than you do. They just have better strategies. They understand the loopholes, the entity structures, and the deductions that allow them to take more of their hard-earned money and keep that legally. But here's a problem. Most small business owners and high-income earners aren't using these strategies because no one teaches you this stuff. You start a business, you hustle, you grow, and before you know it, your income has outpaced your tax strategy. And that's when you start to feel like you're working for the IRS instead of yourself. The good news, well, you can fix it. And today I'm going to show you how you can legally cut your tax bill by choosing the right business structure. So this one's really for the business owners. Today I'm breaking down sole props, LLCs, and S-Corps. And what do they mean for you? How do they affect your taxes? And most importantly, how choosing the right structure can keep more money in your pocket. I'm going to show you some real life case studies of business owners who were overpaying by tens of thousands of dollars and just the simple changes they made to stop that. By the end of this episode, you'll know exactly how to structure your business to keep more of your money. So let's go right into it. And just a side note here, if this episode gives you an aha moment, hit subscribe, share it with a fellow business owner, send a DM if you want to help this, set it up for yourself, set it up for a family member. Please share, like, subscribe so we know that this content is helpful. So let's start business structures first. Here's a reality. If you don't actively plan for taxes, you'll overpay. The system is designed that way. The IRS doesn't give you a playbook on how to save money. They expect you to figure it out yourself. And if you don't, well, that's just more money in the government's pocket. So let's talk about your business structure, because this is the foundation of your tax strategy. Most business owners don't realize that choosing the right entity can mean the difference between paying thousands or keeping thousands. And for context here, I'm just talking about operational businesses. So we're not talking about rental properties. We're not talking about holding companies or other passive investments. Operational businesses. So first up, and the first structure is the default structure. That's the sole proprietorship. Or if you've got a partner, a partnership. This is the IRS's favorite entity because it's worse for you. If you've never legally set up a business entity and you're doing business, congratulations, you're a sole prop by default. But here's a problem with that. Every dollar that you make is taxed as your personal income, meaning that you don't get certain tax breaks in certain areas. For example, the self-employment tax. You pay 15.3% in self-employment taxes before you even start paying your income tax. On top of that, you have zero liability protection. If you get sued, your personal assets are at risk. The IRS loves sole props because they're the easiest to overtax and they're the easiest to audit. They show up right on your Schedule C on your personal tax return. If you're making over $50,000 a year, it's time to upgrade. Or if you have a chance to get sued, you might want to consider this next step. So next up, what do we have? We have an LLC. This gets you protection without the tax benefits. An LLC is a step up from the sole prop in that it gives you liability protection, meaning that if someone sues you, your personal assets are safe from your business if you're following the corporate formalities. But here's what most business owners don't realize. By default, an LLC is taxed just like a sole proprietorship. If you have a partner, it would be a partnership. What does this mean? Well, it means that you're still paying all of the self-employment taxes on every dollar you make. So does an LLC protect you legally? Yes, if you're following the rules. But does it save you money on taxes? No, unless you take this next step, which is electing to be taxed as an S-Corp. So last but not least, we have the S corporation, and this is kind of the wealth builder's secret. This is where business owners start playing the game the right way. This is an election you make with the IRS using Form 2553. When you elect S-Corp taxation status, you get split your income into two different parts, a salary and a distribution. Each portion is taxed differently, and this is what it means for your taxes. So you pay self-employment taxes on your salary, but not your distribution part. This allows for you to avoid the self-employment tax on a portion of your income. The result, saving thousands in taxes legally. So let's break this down with a real-life case study of a client. I've changed the name for privacy purposes. So let's talk about really the common scenario, the contractor, the freelancer. If you're making money as a freelancer or a solo business owner, but you haven't set up the right tax structure, you're just giving and donating thousands each year to the government. So let's meet Sarah and talk about how Sarah fixed her problem. So Sarah was a marketing consultant earning $120,000 after deductions. Every tax season, she dreaded the bill. This year, she saw over $30,000 and almost cried. Felt like she was just working to pay the IRS. So what was wrong? Why was she paying so much? Well, she was just a sole proprietorship. She had an LLC and she thought, hey, I've got an LLC, I'm saving on taxes. But as you know, the sole proprietor meant that she was paying self-employment tax on every dollar she earned. So that 15.3% really added up. On $120,000 of income, she was paying over $18,000 in self-employment taxes alone. She had liability protection because she was using the LLC properly. So in that sense, she was protected, but she was losing thousands each year because of the inefficiency. So what did we do to fix it? Well, we made a retroactive S election. We gave her a reasonable salary of around $50,000, which was subject to the self-employment tax. The remaining $70,000 she took as distributions, meaning that she avoided that self-employment tax on that portion of it. What was the result? Well, she saved over $10,000 in taxes every single year going forward. That was enough to fund her Roth IRA and invest even more. Just think about that. If she invests this difference over the next 30 years, that could be over $1 million, assuming a 7% annual return. How would $1 million affect your life or retirement? If you're making over $50,000 as a business owner and you're still a sole proprietor, you're paying too much in taxes. DM us S-Corp and let's fix this. Your business should work for you, not the IRS. If you're making money, but you don't know where it all goes, let's fix that. Most people overpay in taxes simply because they just don't know what they don't know. Don't be that person. DM us today. A good tax strategy isn't built in April. It's built all year long. So let's get you on that right path today and don't wait till it's too late. So let's recap. If you're a business owner, freelancer, or high income earner, your tax plan really matters. But for your business owners, that business structure matters more than you think. You could be overpaying tens of thousands of dollars every year just because no one told you there was a better way. But now you know, and now you can do something about it. Here's what I want you to take away from this episode. First, if you're a sole proprietor and you're making over $50,000 a year, you're paying way too much in self-employment taxes. Please consider the S-Corp. If you have an LLC, but you haven't elected an S-Corp status and you're an operational business, you might still be paying even though you got that LLC. Run the numbers. It could literally save you thousands. And if you're making 6 or 7 figures and you're still filing taxes like an employee, you're handing over to the IRS extra cash, it's time to get strategic and it's time to start planning. I don't want you to just listen to this episode and go back to business as usual. Take action. The IRS isn't waiting to keep your money, so why wait to keep more of it? If anything I said today made you think, that's me, and I need to fix this, here's what to do next. Subscribe to this podcast. We break down real-world tax strategies every week so you can stay ahead. Share this episode with a fellow business owner. I guarantee they're probably making one of these mistakes too. Send them this episode and help them save thousands, and then reach out, schedule a free discovery call at bristertaxlaw.com. I appreciate you tuning in to the Wealth Planning Podcast with Brister Law. My name is Anthony Brister. This is more than just tax savings. It's about building real wealth and protecting what you've worked so hard for. If you're serious about taking control of your tax strategy, don't wait until next tax season to start. Reach out to me today. Let's connect. Let's get your business working for you and not the IRS. And I'll see you next episode.